Hi, good evening to all our friends in Mexico. Pleased to be here today. First of all, let me start by thanking the Riskmatics crew, Enrique, Sarah, and of course, I'm grateful to my friend Ellen Baruch, who was kind enough to invite me to speak to you again this year. Climate risk is, of course, a very hot topic. And climate risk is very, very broad. I mean, there's climate risk, there's ESG, there's sustainability. So today I'm going to focus a little bit on giving you a quick overview of um, of a quick introduction to what climate risk is for those of you who may not be so familiar with it. One question I always get, I talk to a lot of banks about climate risk, and one question I always get is, what are other banks doing on this? So I'm going to share with you what other banks are doing on this globally from my conversations, of course. Also, a little bit about what to expect. There are a lot of things going on. In fact, there are things going on every week, every day on climate risk. So we just want to keep track of what to expect. There are opportunities. We are so used to talking about risk, but they are, of course, a lot of opportunities as well. And I'm going to end with a little bit of chat around analytics for climate risk. I am an analyst. My background is in credit scoring, credit risk, but I see this as an analytics issue, and I'm going to talk to you a little bit about what some of those are. So why are we talking about climate risk? I know we say climate risk, right? So we want to be defensive. There's this risk associated with this. There are also opportunities. Of course, there are risk. The World Economic Forum says that the credit ratings of a lot of the countries is going to move. The credit ratings of a lot of companies are going to drop. We know that. We know there is risk. But if you look at the second paragraph, the to counter both physical risk and, more importantly, transition risk, to make economies more resilient, governments are going to make a lot of investment. The OECD estimates, at least, that it's in the order of trillions, right? There's a lot of money, and most of this is going to be intermediated through the financial system, which means you, the bankers. Now, this is separate from issuing green bonds and ETF funds, and giving out loans, of course, to high growth industries, green tech industries, etc., etc. There's a lot of dollars at play here, right? We all need to work on this, but from a banking perspective, of course, there's risk, but there is a lot of opportunity as well. So look at it from both sides. Now, let's talk a little bit about um, climate risk. So there's two main types of risk that people talk about when it comes to climate as far as banks are concerned. One is physical risk, and that just means that there are going to be a higher frequency and higher severity of adverse weather events. And we are seeing that today in a lot of countries in Asia for floods, in the US, in Europe for droughts, for example, fires, hurricanes, all of those things are going to hit us with more often, and of course, with more severity. And of course, people think, oh, this is 30 years, 20 years down the road. No, it's not. It is now. And the insurance companies have known this for many, many years, right? The data suggests that this has been happening for a long time. So this is a risk for banks as well, because of course there is collateral damage and things like that. Now, for banks, the other big issue is transition risk. And so transition risk is, I mentioned the decarbonization. A lot of countries have pledged to go with the Paris Accord, right? Keep the temperatures below 1.5, 2 Celsius. And how are you going to do that? And how are you going to do that? We're going to do that by reducing our reliance on carbon fuel, right? On fossil fuels, on oil, gas, coal. How are you going to do that? Today, most of the economy runs on these things. So to transition away from oil, gas, coal to cleaner represents an opportunity, but it also represents a lot of risk. If you are a bank with a lot of exposure to these industries, of course, you have risk. If you are in an area where there's a lot of activity, you are at risk. And once again, we tend to think of this as far, it's 20 years, 30 years is going to happen in 2050. It's happening now. And these are just some of the kind of headlines I grabbed, just, some recent, some not so recent. I live in Canada and we have oil in Alberta. It's a particularly dirty oil. Right? It's called the oil sands. And there are some insurance companies like Munich Re, like Hartford. They have stopped insuring work. If you're working in the Alberta oil patch, they're not going to insure you anymore. There are a lot of banks, mainly because of reputational risk. There are a lot of banks like Societe Generale, like RBS, Barclays, HSBC, Deutsche, you name them, right? They've all come up with pledges that they will not finance any more coal operations, for example, or they will not finance any companies that derive more than 50% of their revenue from oil, for example. They will no longer buy bonds from companies involved in oil. This is all transition risk. It means if you are dealing with oil, if you're dealing with gas and coal, your sources of capital will dry up. I know in the old days, a few years ago, we all used to think, you know what? Okay, so the American banks won't lend you money. Well, the Chinese banks will. Well, guess what? A few months ago, the Chinese regulators banned Chinese banks from financing coal operations outside of China, right? So this is going to be global. So what does that mean? You know what? There's a lot. Let me take one vector. Okay, I call it a vector, right? So let's take one vector. Let's say you're in an area that gets hit by hurricanes, okay? Or let's say you take an area where there's a lot of oil and gas business. So what happens? You're going to get hit by a hurricane. You're going to get hit by a hurricane more. It means what? It means disruptions to economic activity. Shops will not open, businesses will not open, the infrastructure gets destroyed, right? Um, Economic loss. If you have commercial customers, there's a PD. You have corporate customers, there's PD, probability of default. Now, let's say because of these, because the financing for oil companies will dry up, there is less capital, there's less business, there are less jobs needed, people will start to move away from these areas, or there'll be more property damage. You might not get insurance for a property. The value of properties will go down. That's loss given default. That's your LGD, right? People will start moving away, right? Now, so that's your LGD, that's your PD, that's your retail risk, that's your corporate risk, that's your small business risk, right? SME. If you are a government in one of those states and you have issued bonds and you rely on tax revenue to pay those bonds, your ability to raise taxes, your ability to raise revenue to pay for those bonds will go down. And there's your sovereign risk, right? So we just take one vector of an area getting hit by more hurricanes, and it takes you through PD, LGD, SME, retail, corporate, and sovereign risk. That's the chain. And that's where the financial risk impacts come in. Good. Let's talk about what is being done. Well, like I said, this is not in 10 years. This is not in 20 years. This is now. Areas like Miami are going to get hit very badly. Areas like New Orleans are going to get hit very badly in the US. In other parts of the world, we already have seen this in the US, in India, in the UK, because in France, because of drought conditions this year and last year, the yields of rice, the yields for grapes, the yields for fruit, for wheat in India is going to be lower than normal. This is going to cause food crisis in some countries. This is going to cause the price of food to go up. Okay, this is now, and of course, we have some evidence in the U.S. There are some studies that were done a couple of years ago that show that after every hurricane, for example, the PDs, the probability of foreclosure, the probability of default went up by about 3.5% points 1 year after a hurricane, and around 5% for 3 years after a hurricane. There are long-term impacts, right? So if you are holding bonds and if you're holding mortgages in some of these areas, you need to start thinking of those, right? And as I mentioned, of course, there are a lot of banks that are responding to transition risk. EIB, Goldman Sachs, JPMZ, all of them. Now, just be careful because a lot of these banks are still lending money to oil. They're still lending money to fossil. And I'm going to talk about this a little bit more, right? There's a tightrope. There's a tightrope between managing your reputational risk and trying to make money. Now, let's be realistic. So we also have a lot of financial institutions that have set net zero targets. And so you're going to go you've set for net zero for 2030, 2050. So there's demand, there's pressure. Well, there's pressure from the regulators, which is okay, that's there. There's pressure from consumers because they want to deal with better companies. But the people who have the most pressure are the ones who have a lot of money. And so there's this group of investors, right? And they have said that they expect the people that they lend money to or the people they invest in to be aware of climate risk and to have plans to address climate risk. It's just like BlackRock; they've been voting against institutions that don't have climate action plans. They've pulled back a little bit now because they're getting a bit more realistic about this. But when somebody with $11 trillion in their pocket tells you to do something, you need to listen, right? So there is, of course, a lot of pressure coming in from all sides for you to do something. Now, you also have to mean it, right? This is from Canada. So some of the Canadian banks have tied their CEO pay to ESG. So there are some ESG targets. And again, ESG is a separate topic, quite fuzzy, but they've tied CEO pay to ESG targets. We mean it, right? It's not just for show. We really mean it. Now, why do I say this? I say this because banks, as I said, are on a tightrope. You're trying to make money and you're trying to look good at the same time, which is where this kind of reports comes in. This is from the Rainforest Action Network, and they have a list of the dirtiest banks in the world. Okay, it's a long list. Now, I know Canadian banks have a reputation. Canada has a reputation of being Boy Scouts and good and all that. And so do Canadian banks. There's green banks, and and it's justifiably, they talk about all the good stuff that they're doing. But they're also among the dirtiest banks in the world when it comes to lending money to fossil fuels. And I'm showing you this because there is a lot of money at the table and you got to be realistic. This is complicated. Okay, this is complicated. So yes, you're managing your financial risk, you're managing your reputational risk, you're doing all your net zero, but you're also trying to make money until that last barrel of oil comes out of the ground, right? Now the trick is, of course, not to get too bad of a reputation. So yeah, there's the dirty dozen. There are Canadian banks on this list. Now, here's where you don't want to end up, right? There is a lot of greenwashing, especially when it comes to ESG, and it's not new, right? In 2019, oh sorry, no, in 2009, the G20 countries, including Canada, they pledged to cut subsidies for fossil fuel companies, right? For oil companies. It's now 2022, and that hasn't happened yet. Right. In fact, the oil companies are getting as much subsidy as before. There were a lot of loopholes in those pledges. This may be happening now. Just be aware. There's a lot of greenwashing. People are getting tired of greenwashing. And so ESG is a double-edged sword. Yep, it will work for you. They found that a lot of the ESG mutual funds and ESG funds had almost exactly the same holdings as normal ETFs and mutual funds, except with higher fees. So people are catching up to the fact that a lot of banks are just making money off of ESG, right? There's nothing good in there. So just be very, very careful. Right. So what are banks doing? Let's talk about what banks are doing out. So everybody is trying to manage this, right? There's a lot of questions. There are a lot of questions on climate risk. There are very few answers. So here's what we're doing. Climate risk used to be in corporate social responsibility, and now it is moved to risk management. They are chief sustainability officers. The CRO has climate risk on their radar. There is a lot of data gathering going on. And so you know that climate risk, the math isn't new, right? It's a new kind of risk. The biggest problem with both ESG and climate risk right now is data, right? ESG factors are all over the place. So you know what all the ESG factors are great. Where you're going to find data for the ESG factors? A lot of it doesn't exist. For climate risk, a lot of the data doesn't exist. And if it exists, so let's say you get weather data. Okay, good. How do you tie it? How do you link it to a counterparty, right? And how do you rate that counterparty? Difficult questions, but a lot of banks are starting to collect data, physical transition risk factors, transition plans from their large corporate customers. They are asking them, give us your transition plans. right? ESG data, resilience, emissions data, the scope 1, scope 2 stuff that you want to know. Of course, some of them are sending questionnaires to their large corporate customers, and some of them are relying on third parties, right? So there's a lot of data gathering. And some of them are collecting home data. Like if you have mortgages, for example, they're asking the homeowners, how far are you from the water? What is your elevation of your property, right? How far are you from the river? How far are you from the sea, to manage the risk? Some of them are asking, how old is your roof? Right? How old are your windows in your house? Because the damage from hurricanes is related to, the older the house, the more, weaker the infrastructure, of course, the more damage there is, etc. Now, the climate risk rating is being used to lend to corporate entities. It's mostly judgmental. So a lot of judgmental ratings for lending. Of course, there are stress tests, and I'll talk about those in a bit. A lot of stress testing going on, ratios and banks, rating models. They're trying to find out, okay, well, if we stress these risk factors, climate risk factors, how does it impact PD, LGD? How does that impact the property value? They're trying to model this. A lot of speculation at this point. There's some physical risk that is easy to model. For example, some banks have done this. They've taken, a flood or a hurricane, counted 12 months, 2 years, and they measured the increase in default rates a year, 2 years down the road for a category 2, category 3, which is good, right? It helps you manage the allowances for losses. It helps you manage the overall loss forecasting. It doesn't help you manage individual properties, right? But it's useful. I know in UK there's a lot more work. We have a partner who's done physical risk modeling in the UK, and they went right down to the street level, and they were able to help banks in the UK actually price. So in the UK, there are some banks that will charge you a premium if you live in a flood prone area, and I think that's the direction in which we're going. Like a lot of areas will become unmortgageable. um, Lots of POCs I've seen, physical risk ratings, of course, on your corporate assets, large, if you've got a very large collateral, significant collateral, banks are getting physical risk ratings on them, fire ratings, hurricane ratings, flood ratings, drought ratings, if you're relying on water, right? And of course, ESG ratings, which is a whole different game. A lot of ESG rating providers, like 50 ESG rating providers, all opinions, right? So I know some banks, and we did a project on this. SAS did a project. We got ESG ratings for a whole bunch of counterparties, and we got ESG factors on a whole bunch of counterparties. And so we got a lot of risk factors. The problem is, for a lot of the counterparties, they didn't have data on the risk factors. So we ended up with a very small set of data where we had data on everybody, right? So right off the bat, there's a problem. Second thing, what we found is that a lot of the variables were counterintuitive. This is new data. Like, we've never worked with this data before. So we found that, for example, the size of the company was positively correlated to ESG ratings from external providers. The bigger you are, the better your ESG rating. But the profit margin was negative, meaning the higher your profit margin, the lower your ESG score, right? So things like this. So I think, again, we got to work with this data a little bit. So how do you embed climate policies into lending? Well, we know there are policy issues like lending to people who work in sensitive areas. Of course, there's green mortgages, loans, a lot of ESG funds where there's a lot of greenwashing as well. Some banks are giving incentives. If you want to buy an efficient appliance, if you want to buy an e-car, if you want to fix your roof with efficiency, if you want to do home efficiency, they're giving you a break on the interest rate. It's a very small part of the operation, but they're doing it for what's called the halo effect, right? You're the bank that gives people discounts for buying e-cars, or you're the one who gives people discounts if they buy efficient appliances, for example. So resilience analysis, of course, transition risk is also political, right? The government can come in and say, I'm going to increase the fuel taxes, and another one comes in and says, no, we won't, right? Last week, the Holland government announced some curbs on methane, I believe it was, because they have very intensive farming there, right? Animal farming. And when they announced curbs, one of the banks took all their farming book and made it into designated it as high risk, because suddenly, because of government policy, your entire farming sector is now high risk, right? So these kinds of things happen. So what can we expect? Well, they've seen a lot of European stress testing. There've been a lot of stress tests. Um, it's okay. I like stress testing. I like the scenario analysis, but it is mostly speculation, right? It is speculation. You're looking at what's going to happen in 30 years' time, in 50 years' time. ECB, Bank of England, all did this stress testing. They found, the impact wasn't that big. It was just 2%. The CBS, the UK, found 10 to 15% hit. I don't necessarily focus on the numbers because the numbers aren't really telling you much, right? It's 50 years into the future. I see this as directional. So they found out, one, the physical risk is nonlinear. Very good. They found out, for example, if you do early, well-managed actions, that means don't let it go and wait until things get bad. Don't do that. It's going to cost you more, right? Not doing anything will cost you more. If we start doing things now, well managed, that's going to be the easiest way for us to deal with it. That's what I see. We identify areas at risk, right? Sectors at risk, for example, stuff like that. These are very sensitive tests, right? You're looking at 50 years into the future. One thing that surprised me a little bit was so few banks are actually looking at their data, right? You can see most banks, for almost 50%, are looking at climate and environment, have some governance in place, have some people in place to manage it. They're looking at some of it for lending, but only 7% have plans out to address data gaps, right? So I know that's where the problem is. That's where you're going to focus. So let me talk a little bit about the OSFI, the Canadian stress test, which was very interesting. And this is very similar to other stress tests that have been done in other countries. So they did plausible but intentionally adverse, right? So this is not meant to be reality. This is not meant to be a forecast. We came up with some scenarios to see, what kind of results we'll get. And they only focus on the 10 most emission sectors, intensive. That's a good way to do things. Why are you looking at 800 industries when only a very few are going to be impacted, right? What they discovered, I mean, forget the numbers. Yes, they discovered there's some industries are going to have a 400% increase on PD, but the stuff that you discover is this data gaps, right? All the banks that have done stress testing exercises, the best thing they've discovered are things like data gaps. What data do we need? What data are we missing? Where do we go get it, right? To be prepared. Methodologies and challenges, of course, knowledge gap, knowledge of your portfolio. Most of banks here, they underestimated how long it would take for them to do this analysis, right? So we found that out. Limitations, consistency among the banks, all of these issues. But you know what? It points you in the right direction. But as the Canadian regulator says, there are questions on the robustness of the estimates. Of course, we know that, right? What they also discovered are other issues for things, example, interlinkages between the risks, static world. I mean, you assume that your balance sheet is static. That's a problem. Nobody's balance sheet is static for 30 years. And so, the numbers can be up or they can be very much down, right? Fire sale issue. Here's the thing. If every bank in the world, for example, if every bank in the world says they're going to be carbon neutral, right, net zero by 2030, that gives us 8 years. So everybody will sell all their fossil fuel assets at exactly the same time so that everybody will be net zero by 2030. It means the value will drop like a stone because everybody is selling it. It's like, if you're, I don't know if you're old enough to remember Black Friday in 1987, this is what happened. Everybody was selling at the same time, right? Is that what's going to happen? And so your estimates for the value of your assets may be much, or your estimates are much more optimistic than what they would be, right? So there are issues like that that are coming up through these tests. Very, very good. And then they get insight into, what are the banks doing. Now, again, I see this as directional, right? I see this as directional good results. And you can see that, oil and gas is going to be badly impacted. Electricity is not going to be impacted. Livestock, yes. Forestry, a little bit. But forestry is a very small portion of the exposure, etc. What this does, it helps you focus on industries and sectors and for information for risk management, right? That's what's good. We did a survey at SAS last year. I asked a couple of questions, right? So it's number one, what about modeling? So I'm in credit risk, right? I do credit scoring. So I was very interested in, okay, what are you doing with your models? And so not surprisingly, most banks right now have judgmental overlays on their risk models for climate risk. It is judgment, right? It is judgmental overlay, just like most banks have judgmental overlays to account for COVID. right? I talked about COVID last year. A lot of banks have COVID models that they have had before COVID, and now things have changed, and now we're going to do a recession. So judgmental overlays, great way to deal with this. A lot of others have said, yeah, you know what, we'll use existing models. So by the way, this is being done. So what a lot of banks have done, if they've gotten climate risk ratings, right, or ESG ratings, climate risk ratings from external vendors, and then what they did is they took a lot of factors internally and they tried to predict the external rating, right? This is what we did, right? It's called shadow ratings approach. And that way they understand what factors are important, what are not, right? Some correlation. I've also got customers who took ESG ratings and climate risk ratings and they try to correlate them with PD, right? So for example, there's an ESG rating. Is it related to your credit score? Is it related to your risk rating? To find out. So it's just a simple regression with climate risk ratings and PD, for example, right? So they want to know whether these ratings have anything to do with credits, or you're just adding a bunch of risk factors for climate risk and ESG, and they have no relationship to PD, right? So they're doing some of that work. So yeah, there is recalibration going on. Climate stress tests. Again, I wasn't surprised. The biggest use is policy and direction. You can't trust the numbers. Hey, listen, I'm with credit risk, right? I do credit risk, I do credit scoring. And we build 12-month models for PD, LGD. We build 2-year, 3-year models. And I don't even fully trust these numbers for 2 or 3 years, right? You're telling me to believe numbers for 30 years, 50 years. I don't think so, right? So yes, the stress test will drive, policy and direction, some decarbonization, for example, simulations to understand where we're going, things like that, and some lending. So where are banks? I know you guys want to know this. This is from my conversations with my customers. Now, this is what the leading banks have done this, right? Carbon zero pledge is gone. Scope 1, Scope 2 mostly done, right? Climate action plans done. Methodologies, they have identified sectors at risk through either stress testing or through judgmental, right? Internal governance structures, chief sustainability officers, yes, done. Risk management frameworks, done, right? Now, where they are now is looking to test methodologies. They're looking to integrate climate risk into lending and investing, mostly from a judgmental perspective, right? A lot of the big banks are advising their customers, right? They're advising their customers. What does that mean? Um, if you have large corporate counterparties, your scope 3 will depend on how fast your counterparties decarbonize. And so because the banks have expertise, they're advising the large corporate customers on how to decarbonize, how to get carbon action plans, how to identify scenarios, different pathways for, I mean, there's different decarbonization pathways and all that transition pathways available. So they're actually advising their customers. Of course, there's green bonds, ETFs, all of these things. Carbon climate action plans are getting executed. Governance, of course. Look, climate risk is going to be going to be in every sector of the bank, right? Every section of the bank, which means it needs to have the same governance, same oversight, all of these things, right? So that's what they're doing. They're taking climate risk and trying to integrate that into existing structures, right? Executive committees, the frameworks, reviews, dashboards, all of this stuff. So this is happening now. Of course, what we're looking at is to incorporate climate risk into enterprise stress testing a bit more. Scope 3, big problem, right? Everybody's struggling with scope 3. And as we get more and more data, of course, better climate analysis. It's a journey, right? Now, I know I talked about this a little bit, but you know, we talk about the impact of the scenario analysis, right? And I say don't trust the numbers. And this is again part of the reason why the ECB had climate stress test last year. Somebody at Grant Thornton actually applied those numbers to an actual portfolio and found that the impact is going to be so negligible, so small. And he goes, why are banks actually worried about this, right? Again, not to be cocky. Let's not be cocky, okay? Let's not be arrogant about this. I think most banks will be okay, but please understand this is going to be horrible, right? Especially physical risk is going to be very, very bad for humankind. Countries might disappear, islands might disappear. But so when we say things like, yeah, you know what, I'm a banker, I'm going to be okay, I'm going to make lots of money. Well, let's be a bit humble about this, but also, be humble, but also question the data. Okay, we're risk managers. You got to deal with facts and analytics. So question the data. So opportunities, of course, there are lots of opportunities out there. Future growth industries, there's going to be a lot of investments, solar, clean tech, what is called clean tech, right? Energy storage, battery. Are you in touch with the leaders of tomorrow? Are you going to lend money? Do you know who you're going to lend money to 2 years, 3 years, 4 years, 5 years from now, right? Do you know who these are? Green bonds, ETFs, of course, mortgages, financing to transition, advisory services is an opportunity. Of course, it is mostly reputational right now, I have to say. It also has to do with hiring and retention of employees. There is consumer backlash, right? Greenwashing is an issue. And so do you want to be like like the cigarette companies, right? Nobody wants to work for you because you're the bank that finances all the dirty activities, right? You got to think about some of this. Right. Let's talk a little bit about analytics, and I'm going to end in a few minutes. So climate risk analytics, we know that it's there. We know there are some challenges, right? So we know there is no data. Huge challenge. There's a lack of empirical data. For physical risk, there's a little bit of data. Overall, even the data that is there is at a district level, it's at a country level, state level. There's not enough micro data for you to use for things like individual lending, right? So that's an issue. There's also interpretation. Like I said, we looked at ESG ratings data, and we found that a lot of the variables were positively correlated to ESG. Some of them were negative. Like the more women directors you have, the better you are, right? It's positively correlated to ESG ratings. But we found that the more subsidiaries, so the more subsidiaries you had, the worse your ESG rating was, which was very interesting, right? The bigger the bank, the more women is good, but if you have a lot of subsidiaries, it's not very good. And so this is why with a lot of the ESG ratings being judgmental, you really have to test some of this stuff, right? Now, this uncertainty over the long run, we've talked a little bit about this, right? 30 years, 50 years, very long term. And secondly, okay, let's say I do the calculation for 30 years, right? Let's say my PD is good for the next 30 years. How many loans does the bank give for 30 years, right? If you are giving 3 years, 5 years, 2 years, 4-year loans, why are you worried about this, right? You have time. Of course, you got to look at your long-term horizon, but immediately you don't really have an issue, right? So there's tragedy of the horizon. And of course, there's science and other things that, we think if everybody works together, we're going to solve this issue. So, projecting over that time horizon is not very, very good. And of course, there's a lot of variation, just like COVID, right? COVID, there was winners and losers, right? I looked at the winners and losers during COVID. Some sectors were good, did very well, made lots of money, and some sectors did not, right? Travel was down there. Groceries, the grocery industry here made a lot of money during COVID, right? So same thing with climate. It's not going to be everyone losing. There are a lot of variations. There's a lot of geographical variation. There are a lot of sectoral variations. And of course, integration into BAU process. Okay, all of this analysis is nice, right? All of this analysis is nice, but how do you take all of this and integrate it into your existing processes, right? Your risk models, your governance, your calculations, all of this stuff has to be there. So, we looked at this. I mean, we've been looking at this, and I got a few things that I want to share. One thing that, the head of one of the largest banks in the world, right? The head of climate risk told us that climate risk is the greatest big data project for our bank. Don't underestimate the data work. Okay, don't underestimate the data work. This is going to be difficult. We also had some regulators on some of our webinars, and one of them said, look, you know what? Yes, we're doing stress testing and scenario analysis, but we're not so much interested in the final number. We're interested in your journey, right? So bear that in mind. The process is much more important than getting the final number, which is again what we talked about earlier. You have to do this. and be agile. So one of the guys who was the head of climate stress testing told us, you know what, be agile. Don't get lost in the technical detail. Don't get lost in the formula, right? Just like for credit scoring, just like for risk modeling, don't get lost in the formula. Put your head up, look at the overall overall process. So how do we end this, right? Let me finish this out. So we know all the issues. I know you got data issues. I know you got lack of data. I know you have a lot of data and you can merge match it to your counterparties. I know you got to do modeling on this, and I know you got to do governance, and I know you got to do all of that stuff. So what can you do today? Look, with all the vagueness, we think of the bigger picture. So this is what SaaS, or this is what I've been advising my customers. With all the uncertainty, what can you bet on today that will last you? Right? What can you do today that will make you more resilient to tackle all of this when you have proper regulations, when you have the data, when you have the directions, you will be ready. So one, recognize that the data is a non-trivial activity. So yes, you got to collect new data, you got to get it in, you got to govern it. Where does it come from? Can you trust the data? A lot of institutions, by the way, for ESG, we're helping some institutions, for example, get data from invoices, right? To look at scope 3, we're looking at invoices. So you have invoices on PDF, we read them using AI and we generate data. A lot of banks are looking at using AI, and we did a project like this. We used AI to read blogs, to read news, to read Reuters, Bloomberg feeds, to generate sentiment analysis, negative or positive, on companies, right? For ESG ratings. So can you trust that data, right? Think of Basel II, right? Think of building your risk models. How can you trust public data like that? So secondly, we get into the modeling. One, you got to figure the data out, right? Then of course you got to feed it into your modeling. And there again, I don't think we need to invent new math for climate modeling. We do need to make sure that the climate data is treated just like we treat credit risk data today. Your LTV, your time at employment, your age, your debt service ratio, your financial ratios, right? If you're going to feed it into your models, they better be as robust as the ones you use for Basel II today, for example. Can you do that? Right? It's not the modeling, it's the governance around the modeling. Second thing, I'm a big fan of causality. Correlations alone don't matter much. We're finding a lot of correlations with climate risk data right now, not a lot of causality. So make sure that's there. So once you've done those models, of course, you got to feed it into your interim analysis. And this is where you got decarbonization, stress testing, portfolio design. Banks are looking at, for example, portfolio optimization to decarbonize. Like, so you've got different transition pathways to net zero, right? How do I manage my portfolio to optimize my returns until 2030 when I have to get to net zero? This is what we're looking at, right? This is what we're trying to help customers do. So that goes in. And then up to this point, okay, all very good. You've done lots of great analysis. Congratulations. So what are you going to do? Like if you get ESG ratings today, what are you going to do? Well, we need to use them in our day-to-day banking. When I look at this, when I look at the climate risk and ESG kind of analytics chain, I think of Basel II. I think of the use test. I think of data governance. I think of model governance. I think of reporting, right? Working paper 14, all of that fun stuff. But Basel II, you can do the calculation on an Excel spreadsheet, right? It's not difficult. It's simple. And I guess some of the calculations here are going to be the same. What was difficult about Basel II was the infrastructure, right? It was that governance, everything else around it. And to me, that is the big story around climate risk analytics. Today, I have customers, banks that have trouble dealing with data. They have trouble dealing with integration. They build models that cannot be deployed. Simpler models that take 9 months to deploy, 12 months to deploy, right? They build a lot of these models. They can't put them into their decisioning system. If you cannot handle the relatively simple data, the relatively simple models and reporting for today for credit risk, which we know for 200 years, how are you going to deal with climate risk, right? So what I'm advising customers to do is look at the full value chain, take a step back and look at how you're going to deal with this for climate risk. Are you ready for the data? Are you ready for the modeling? Are you ready for the calculations? And are you ready for the decisions that need to be made? Okay, all of these have to work together. If you need further information, of course, there's lots more. We have a hub. And if you have any questions, please feel free to get back to me. And if you have questions now, I'm more than happy to deal with them. Any questions?
Thank you, Naim, for your insightful presentation. You leave us reflections and tasks also. So many things we have to do in the future to face this huge challenge.
Yes, we have a few questions to reflect on the importance of climate change.
Well, first of all, we are talking about an area where ethics are a great issue to determine in the future how it will have to evolve. And I talk about ethics because it's far away from this greenwashing or the policies that will try to show that something is in process to be done. We have to go on depth and extent to real solutions. How do you see it's going to evolve on the basis of the financial sector, on the basis of the risks for the financial sector in the whole world, and mainly because it takes the social commitment. It takes the fact of the people that has to be committed on a real change to make things happen. Naim.
Thank you. Great question. For climate risk, we can say that it is mostly objective and analytical because we can measure carbon emissions. There's GSG, there are PCAF, people who are trying to standardize how we measure emissions, right? So when you talk about ESG, the E part is mostly objective, measurable, right? Now, you touched upon a very important point, the S part, and I dare say the G part as well, right? Because ESG is very fuzzy. In my personal opinion, we should separate the E from the S and the G, right? Because ESG put together, it doesn't make a lot of sense. Separate the E out, S and G is more ethical. Now, there are, of course, a lot of issues there. When we started looking at ESG data, there are things, there are organizations that tell you the risk factors. Number of women managers, for example, number of ethnic minorities who are managers in your organization, number of women on your board, for example. Some of these things are tracked for the very large institutions. Most of these are not. For most of the people that you lend money to, we have no idea how many women managers they have, or they have to start collecting it, which is a big effort. Now, why number of women? We, again, out here in America, in Canada, US, in Mexico, other countries, we recognize this as a basic human right. The same ethics that we feel are important in our society may not have the same importance in other societies. What if you're rating a company based out of Saudi Arabia, right? How are you going to rate them based on ethics, ethical standards of the US or Europe? It's problematic, right? Of course, we know there are universal ethical standards, but when you get down to the details, you have to ask all of these questions, right? Now, for me, at the end of the day, yes, there's greenwashing and all this. So my question to customers, when I talk to them and they go, look, we want to talk about ESG, right? The first question I ask them is, why are you doing ESG? Why are you into this? Are you trying to make money, revenue? Are you trying to make profit? Are you trying to make a quick buck, right? A quick buck meaning we have 2 years, let's get out some ESG funds, make a quick buck, and then this thing's going to tank when people become smart, right? Are you trying to do that? Or, final question, are you trying to change the world? All right? And this is why it's important, because it determines how you measure your success. If it's revenue, count the money. If it's a quick buck, count the money. If it's changing the world, you cannot measure success by revenue. You have to measure success by impact. right? And so when a bank lends money, looking at the ROI, you also have to say we are a bank focused on sustainability. What we're going to do is we're going to measure the impact of our project. So did it reduce greenhouse gases? Did it increase the income of the people that we finance, right, or the area that we finance? Things like that. I know that's a long answer, but you asked the question on ethics and how they're related, and it's complicated, right? You got to peel the onion. But thank you, that was an awesome
Well,
question.
you touched a word, sustainability. What about to base this kind of risk measurement on the basis of sustainability? In fact, in UK, you have developed a lot that viewpoint, and mostly the ethics, the way on with the organizations, all kind of organizations, they take sustainability to develop plans in the future and also for their operations. How do you feel yourself about evolving all this risk analysis on the basis of sustainability? Because this is not whether I am going to save the world. It's going to be how my company is going to be respectful, not being harmful with the world. And how do people we work in a certain circle, we are going to behave respectful to the world we are living and all what goes around it. So I go
Exactly. And
through that
again,
question. How do you feel about evolving to a sustainability measurement? Something
and
that in UK you have given steps before the rest of the world.
and that's a good point. Um, a lot of folks don't like using the term climate analysis or ESG. They prefer to use the word sustainability, right? That is a much more over-encompassing, broader. The problem again for those of us who work in analytics, because you were used to objective analysis of numbers, right? Show me the PD, show me the ROI, show me the return on equity, show me the RAROC, we're used to that. When you say sustainability, it becomes fuzzier, right? And now the bank is in the business of changing the world rather than, generate revenue for your shareholders. So there is the idea. So firstly, there needs to be a change in culture, the risk culture of the bank, and an overall culture of the bank to be focused away from just profitability into sustainability, right? And then you need to pick and choose what projects you do, and that does necessarily mean that you will say no to a lot of money. Are you prepared to say no to a lot of money in a year where your revenue is slowing down, right? And so that's a tough question for a CEO to answer, right? And the reason why we have all this greenwashing is it's very hard to walk away from a lot of money, right? So are banks ready to walk away from a lot of money?
Well,
But yes, absolutely. Sustainability is where we need to go. It is fuzzy. What I want is I want some definitions around these. I want some solid regulations around these. In Europe, they've made a good start. There's a green taxonomy in Europe that defines tasks by green. Recently, they also came out with something called the social taxonomy, and where you mentioned the social part of ESG, there's a taxonomy of how you measure social as well. But yes, I agree sustainability is a great goal, but I also recognize it's a very elusive one.
well, and social reflects on politics, so every day it becomes much and much more important from risks. And well, I don't want to talk more, but in Latin America we are having great examples of it.
Yeah.
Please,
So,
Claudia.
Naim, there is uncertainty. Your forecast, how will credit be affected? Where will it grow and where will it decrease?
Sorry, how would credit be affected by the uncertainty in the forecast?
Your forecasts from yourself.
Yeah.
Where it will grow, where it will decrease, in which areas or zones of the world or areas of opportunity that you find.
So we have some initial idea at this point, and we have the usual suspects. Anybody who is fossil fuel related. So I look at oil and gas producers, but not just oil and gas producers. If you are somebody who's supplying sandwiches to workers who work on the oil patch, you're going to get impacted, right? There's a downstream and upstream impact of this. If you are the rail company, pipeline company transporting coal, you will likely not be in business from in a few years. So the usual suspects are the most carbon intensive industries, because in order to decarbonize, we have to target the most carbon intensive industries, you know, to be effective, right? The big budget items. So construction, of course, agriculture, of course, animal industry, of course, oil and gas, of course, transportation, of course. These guys are going to be impacted, which is where the biggest credit risk is going to be. Now, if you are in an emerging sector where you are in, for example, in parts of retail, food services, you probably will not be impacted by this, because you don't have a huge footprint. Software companies, SaaS doesn't have a huge carbon footprint, things like this. But I think the lower credit risk, the best ones are yet to come, because that technology is still under development, right? Everybody's trying to find a solution to this. The first person that comes up with a viable solution to take carbon dioxide out of the air, right, is going to be that next company you want to bet on, which is why I'm also advising customers, look for the person that you want to lend money to in 3 years' time and 4 years' time.
You're saying is amazing for the mind. You make me fly. What's coming on, and what will be able to receive investment, and it will be reflected across the value chains. How do banks, and also you are talking about in food industry, mainly in industries like meat, for example, where there is a huge discussion about the grade in the degree in how they are affecting the climate. So how do banks will separate and they will define where it will be able the investment, where the loan can go or where not, or where also the amount of interests, because the risk is higher? How do you think it's going to happen?
Today we are doing some of that today, but we're doing it based on judgment, right? So we talk to the animal companies, bankers will talk to large food producers, large farm owners, and try to understand, what are you doing to reduce your carbon footprint? Because I'm not walking away from this. What I want you to do is I want you to be better than what you are today. So what can you do to reduce your carbon footprint? Now, look, a cow is a cow. It is going to produce as much methane as it produces. I'm speculating. We may come up with varieties of grasses, for example, that reduce the overall methane output of a cow, right? And that's part of it. The other one, of course, is artificial or lab meat. That is going to reduce our carbon footprint. There are Canadian companies actually in Ontario. There are two companies that generate protein from insects, and an insect on a pound for pound basis, the protein generated from it's like a grasshopper. But it takes around I think 500 times less water than raising a cow for 1 pound of meat, right? The same protein. And so we will see more and more of and I think that's a good thing, right? I mean, get out the ick factor. The fact is you're not going to taste the insect, and you're saving the planet. But there are things like this. But today, of course, it is largely subjective. Also today, most of the bank's exposures are very short term, so they're not that worried about this. And if it becomes politically bad for them to lend to meat producers, for example, I'm sure some of them will walk out. But I think that's where we are. Where they are going, I can't really comment on that. There's a lot of technology at play.
You are touching something very sensitive. How we are going to change the way we feed ourselves, how we are going to change the way we sustain society, because in Mexico we eat grasshoppers, and they are great indeed. Mostly with mezcal or tequila. It's something widespread in this country, but I know it's not in the rest of the world, and it's something that we have to accept. We will have to change in a certain future, and mostly not only because we have to move, for example, in the case of production of meat, how we are going to do with the availability of water to produce vegetables and fruits and whatever we want to have from as natural food. So all this is moving the risk. All this is moving the degree of the challenge we are going to face, and something that is going to put also in a new kind of balance what banks have to define and to go over on this challenge. How is going to change also the view of the decision for investment to assure the product system's resilience, the productive system resilience? I think there is something that we are not thinking on the investment for the future. Is it already on the view of banks and the financial system?
This is, and you made a very, very good point. We will need to change the way we live, the way we work, just as COVID helped us change the way we live and work. Right? It has a permanent impact. Climate risk will too. The the traveling that we do, etc. In terms of how banks are looking at the resilience of the production processes, yes, they are. This is where most of the banks are asking their major borrowers for climate action plans, for transition plans and resiliency plans. If the government comes up, or if the government increases the carbon tax, for example, how will you deal with it? How will your ROI be? What will you be your cost structure, etc.? How resilient are you to carbon taxes, for example? How resilient are you to the price of oil doubling, for example? How resilient are you to all of these things? So the banks are not just looking at the production resiliency, they're looking at corporate resiliency on things like the climate, things like both transition and physical risk. So yes, absolutely, they're asking all these questions.
So far, resiliency, you cannot measure profits. This is part of the problem. You can measure the degree of the problem and what is going to happen in the future, but not the profit. This is not something I can show to the bank in the moment I will ask for a loan. It's a great challenge.
It is.
Thank you, Naim, for sharing your ideas on this subject of paramount importance. Thank you, thank you.
Thank you very much. It's something you leave us with a lot of reflections and tasks to go over for the next months. Thank you very much, Naim.
My pleasure.
My pleasure.
Y nosotros, Alonso, vamos a continuar ahora con la primera mesa panel de la noche.
La disrupción digital se aceleró en los últimos años, detonando nuevos modelos de negocios y mejorando la experiencia de usuario en todas las industrias y sectores. El sector financiero ha estado